This podcast episode is for investor education purposes only and is not intended to provide and should not be relied on for investment advice. Consult your personal investment advisor before engaging in any securities transaction.
Wild swings in the market as the Fed delivers the most opaque message in decades, and the capital markets strip out premiums only to see a recovery that we're riding on the results from one of the leading hyperscalers. This week, we'll cut into the lack of details and think about what this means for the second half of this year. Welcome to the Wise Investor Show podcast. I'm Chase Hinderstein. It's been another wild week with a large drawdown. The S&P 500 down 1.5% on Wednesday, and a big lack of any real pronouncement from the Fed. But first, we got some data that came out the day after that big drawdown. We got the PCE inflation indicator. It was once known as the Fed's preferred measure of inflation, but they won't tell us if it still is. It came in right on target with 3.3% core inflation. That's well above the Fed's stated goal. And what Warsh did say on Wednesday, well, he didn't say a lot, but he did say that 2% is still the target, and also that there's not some secret acceptable level floating somewhere above that. And this is still above that target, but it's lower than the previous reading. We also saw initial jobless claims well below expectations and lower than the previous period. And the first GDP reading for the second quarter, a reading which is going to be adjusted a few times. But per the Wall Street Journal, the U.S. economy grew by 1.5% in the second quarter, adjusted for inflation, and versus the expectations of 1.8% and a 2.1% reading in the first quarter. So there's a lot of mixed messages, and while the Fed didn't move rates on Wednesday, the data being so conflicted, the market freaked out a bit on Wednesday because Warsh is sticking to his new theme of providing us no guidance and also no color on what their current thoughts are or what the reactions are to recent data flow. A part of the narrative now, and it was mentioned by Warsh himself, is that the bond market is doing the work for the Fed, as higher interest rates may be battling inflation themselves. And with the 10-year Treasury yield now here on July 30th, we got the 10-year at 4.7% and the 30-year now yielding 5.2%, each up 12% and 8% respectively year to date. They are having an impact on lending, at least as it applies to these big businesses who have been issuing bond offerings at historic pace this year, but they're not having that impact on small businesses and the consumer. As according to the Wall Street Journal today, the average 30-year mortgage is about 6.75%. That is up from its annual low of 6.11%, but still below the levels we saw in recent years. Car loans are now still below 7%. And the SOFR rate, along with the prime rate, well, they're yielding 3.65% and 6.75% respectively. That's a lot of numbers, but each are key rates to set the lending costs for many of the small businesses and consumer loans across the country. These rates, at least the mortgage and the car loans, well, they've been rising and they're doing some of the work for the Fed, but none are slamming the brakes on the economy just yet. The problem on Wednesday was that Warsh is making a big point of just not providing any guidance or really even agreeing to tell us what he had for breakfast that day after the markets, having spent the past 20 years getting fully telegraphed Fed's intentions. And Wednesday's meeting had 3 dissents, which is the most we've seen in a meeting since 2006. And the ensuing volatility is what may be expected if they refuse to answer questions regarding their process, what data they're favoring, or anything else in their current approach. In the Financial Times on Thursday, an analyst was quoted as describing the sell-off in the markets and the spike in rates on Wednesday as a loss of confidence trade, as opaqueness drew the premiums out of assets, notably rising the cost of borrowing to the U.S. government. Just as you may expect if companies are no longer required to provide quarterly results, which is being proposed, as any time less information is provided, if nothing else, you have to at least remove some of the premium from your investment thesis because you have that much less certainty or conviction with that much less transparency. To that point, the Wall Street Journal mentioned this week that if companies do opt out of quarterly reporting, not only will their valuation premiums decrease, but their borrowing costs may also rise, which is notable in this year of copious borrowing. But if the Fed is going to tell us to do our own work and not rely upon them for guidance, then they're going to incrementally reduce some premium that would otherwise have been more gotten from more transparency. The markets are not dependent on the Fed to tell us what the economy or inflation is doing or going to do. The market's willing to draw its own conclusions there, but investors don't appreciate being talked down to by the Fed chair, who seems to be telling us to do our own work. And while investors may make decisions based upon their own impressions of the economy, they do want to have a feel for what the Fed's got to do about it. A couple of other items worth noting before I get into any specific companies. We also had the release of updated consumer confidence numbers this week. And I should note that along with the PCE data on Thursday, we also had personal consumption numbers released for June, which were up 0.3% for the period. Lower than expectations according to FactSet, but higher than the growth in personal income for the period. And that's a sign that inflation is stripping out more from the wallet than wage growth and bringing in. We also got the July Consumer Confidence Index for July this week. That ticked down to 90.8 for the month. 90 sounds like a good number, but that's below the expected 92 and declined from the reading of the previous period of 92. Which according to Raymond James' own Larry Adam, that was a new low reading since the end of the COVID lockdowns. Maybe it's a sign of weakness in the economy, but also it's a telltale for the upcoming midterm elections. And to that point, regardless of who's currently controlling Congress and who wins in the fall, according to a report published by J.P. Morgan this month, since 1937, returns in the midterm election years as a whole were 9.2%, which sounds pretty okay, but that's versus a 13.3% return in all the other non-midterm years. They also pointed out that while the uncertainty leading up to the election hurt the markets, as average returns leading into election day were negative on average, they also got a boost regardless of results afterwards, on average with a gain of 6.6% in the fourth quarter. But this is really to keep this all in mind, because maybe over the next few months as they wind on, because the third quarter of a midterm election year historically has been the weakest and most volatile period for the markets of all the 16 quarters of an election cycle. But it's also followed by, on average, above average returns for all those 16 quarters after the election, which historically has led into continued gains into the first quarter of the following year. It's just a bit of food for thought, or maybe something to bring you some calm should we see some rough waters if we see increased volatility in the next couple of months. With that said, I'm going to skip into a quick break here, but I'll return in a moment with an updated stock or two. For the Wise Investor Show, I'm Chase Hinderstein, and I'll be back with that in a moment.
Remember when AI stocks went up every day and massive tech spending was rewarded? How do you separate an abrupt shift in sentiment from business reality? Are now weak tech names opportunities or to be avoided? Tune in every week as we discuss the latest financial trends and what investors need to know. To filter out the headline noise and become a better informed, wise investor, listen to us at The Wise Investor Show at raymondjames.com/The Wise Investor Group. Or just find us on your favorite podcast app. Raymond James & Associates Incorporated, member New York Stock Exchange, SIPC.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James & Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide, and should not be relied on for, investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James & Associates, Inc., member New York Stock Exchange, SIPC.
Welcome back to the show. Before I get into any specific stock names today, I want to emphasize that not only do I personally own these for myself and for some clients, and that is a conflict of interest, but take seriously that what's said here is not a research recommendation or specific investment advice. This podcast is not a substitute for research or professional advice that would be given based upon your specific needs, and we can't manage your portfolios over a podcast. So if you're a client and wonder how any of this is fitting into your portfolio, please give us a call and discuss it with your advisor. And for everyone else listening, please do your own homework and consult with your own advisor and see if this does make sense for you. That being said, with the war in the Middle East still above the fold in the newspapers, as we used to say, and the price of oil bouncing wildly day to day, aside from talking about the war, I want to give a refresher here on what Chevron is doing these days. About a year ago, Chevron overcame a legal challenge and closed on their purchase of Hess, July of 2025, which primarily delivers, and Hess had a few assets, but the primary asset there was a 1/3 ownership of a 10 billion barrel block of oil situated off the coast of Guyana in South America, which increased Chevron's own oil reserves by over 1/3. And this is a field that was completely unknown 10 years ago and is the biggest oil discovery in well over a decade for a country that previously had no oil production. And along with everything else that's happened globally, including obviously what's happening in the Middle East, as well as constraints on oil, if not production, at least exportation maybe in Russia, developments in U.S. fields and so on, well, this may be one of the more impactful developments in the oil business in some time. And that's not even mentioning that more may be available in the area. There may be more fields adjacent to this, and that the relationship with Guyana's neighbor, Venezuela, has become less hostile recently due to obvious reasons, as Venezuela was trying to make some claims to this field as their own ownership, and hopefully now we're not hearing more about that. Other important points of emphasis, though, for Chevron for the coming decades, according to a summary from JP Morgan, is their liquid natural gas operation in Western Australia. It's been a long time since I spoke about Chevron, and this is probably more in the development phase when I did, but this is where their Gorgon project has tapped major offshore gas fields and liquefies them onshore at a port, ultimately for delivery to Asian buyers, which complements Chevron's large gas stakes in the U.S., Permian Basin, and then the often underappreciated or maybe completely overlooked at times assets that Chevron has in Kazakhstan, the Tengiz oil fields, which according to Chevron's own filings is currently producing over 1 million barrels a day, and they say contains over 25 billion barrels of oil, of which their stake they carry on their balance sheets at about 6 billion barrels of proven recoverable oil. It's an important notion in oil business where you have what's scientifically proven, you can carry it on your balance sheet as such, you can borrow it as such, and then there's potentially for more. One other note regarding Tengiz is that according to upstreamonline.com, kind of a business rag there, they emphasize that the flow that Tengiz develops, the oil that comes out of there, relies on a pipeline that crosses through Russian territory onto the Black Sea. So when we think about oil politics and what could interrupt them or allow for them, it's not always as simple as putting a cork in Russian production or blockading somebody else out there, because so many of these interests are often intertwined. Certainly, Chevron's interest in Venezuela had been written off for years and to some degree are returning. But many, many, many people or countries or producers in the oil business are proverbially in bed together. This year, so much of the performance of the energy stocks, of course, are correlated with the day-to-day fluctuations in oil prices, which are dependent on the headlines, what's happening in Iran any given day. But it might be better off to think of the long-term supply and demand trends as, well, I won't recommend a specific stock. I'll also not try to guess where oil is going to be in 6 months right now. But rather, it may be wiser to consider if and how much of an overall portfolio may be allocated to energy and energy demand and energy production in general. In a recent report published by Goldman Sachs on Chevron, they point to recent momentum from what Chevron is doing in these Australian gas interests as a highlight where, as I said, last time I spoke about it, they were still being developed, and now their LNG operations are running at full capacity. And I mentioned in a recent podcast how China has been recently able to ratchet back their oil demand this year, and that was addressed again this week by the Wall Street Journal, who noted that China has cut their oil imports this year by 40%. As one of the biggest consumers in the world, cutting back by 40% Well, according to the journal, they say it acted as this huge shock absorber for what's been disrupted in the Middle East, not just from Iran, but just from the closing of the Strait of Hormuz. And they say that a drop of that size has never happened before, even during global recessions. And it's reflected in the slowing growth of their economy because they've done this at a cost by curtailing certain levels of industrial production. But it's also noted that their overall energy demands are continuing to grow, including their demand for electricity, much like ours, as they too are participating in this AI race and their need for electricity to power it all. And their demand for natural gas is expected to continue growing, pivoting back to what Chevron is doing over there in Australia. What's also important to note for Chevron, looking back again at this Goldman report, is the emphasis on the discipline of their capital strategy. And Chevron and a lot of people in the industry started emphasizing this a few years ago, banking the gains from higher energy prices, which frustrated some politicians at the time, but the companies seem to have learned from the lessons of the past, and they aren't just plowing all this newfound cash back into expensive projects, but per Goldman Sachs, they're exhibiting instead structural cost savings efforts and a robust balance sheet, and pointing that all that new cash flow instead towards higher share buybacks and higher dividends. Goldman's basing their targets on the stock which I'm not sharing. I'm not putting specific targets on the stock. But what Goldman's methodology is, they're just estimating 7% free cash flow yield at today's prices. And they point out that some of maybe the obvious risks here, which would be, a further drop in oil demand due to an economic slowdown. Conversely, China could ratchet back up that 40% decline in consumption this year. Or the oil companies could suffer from a more abundant supply, which is why they're not reinvesting in more and more projects, but rather trying to bank some of that cash. But if there were further developments, if we saw a meaningful resolution in the Persian Gulf and or to the war in Ukraine, well, that could bring a lot more additional supply, both the Russian supply and potentially more Iranian supply to the markets, which would hamper prices. And the Saudis like to, at times, try to gain market share by pumping more and existing at lower oil prices. And that would potentially hurt these types of stocks like Chevron. So not a recommendation to pick it up today, but a refresher on what it is that Chevron has under the hood and maybe what it could mean for their long-term future. All right, that is it for me today. I thought about dipping into the, big earnings news from one of the hyperscalers this week, but I'll just leave that for Simon's show next week. For the Wise Investor Show, I'm Chase Hinderstein. Thanks for tuning in.
The information contained in this podcast represents the opinions of the hosts and guests and does not necessarily represent the views of Raymond James and Associates, Inc., the Wise Investor Group, or their respective affiliates and employees. This podcast is for investor educational purposes only and is not intended to provide and should not be relied on for investment advice. The contents of this podcast do not purport to constitute a comprehensive summary of all information necessary to base an investment decision. Past performance is not a guarantee of future results. Securities mentioned in this podcast may not be suitable for all investors. Seek the advice of your financial advisor or other qualified financial service provider with any questions you may have regarding your individual situation. Discuss any tax or legal matters with the appropriate professional advisors. Raymond James and Associates, Inc., member New York Stock Exchange, SIPC.